Good morning, this is DealBook, your daily briefing on the deals, policies, and power shifts shaping the global economy. It's Friday, August 7th, 2026. I'm Andrew Ross Sorkin, and we've got a packed edition today, from a pivotal jobs report that could force the Federal Reserve's hand, to a structural crisis brewing in venture capital, a landmark ruling against Meta, and a Chinese robotics company about to test public markets' appetite for humanoid machines. Let's dive in. We start, as markets do, with the Federal Reserve. Stocks are trading just below recent highs, but the mood on trading desks is anything but calm. At 8:30 this morning, the Labor Department releases its July jobs report, and make no mistake, this number will be dissected not just by investors, but by Chairman Kevin Warsh himself. The central bank's next move on interest rates hinges on what we learn today. Weak data could buy Warsh and the Fed more time to stay on hold. But a hot number, especially if next week's Consumer Price Index report comes in disappointingly high, could force the Fed to raise borrowing costs to combat persistently sticky inflation. The consensus is messy. Economists polled by FactSet forecast employers added 100,000 jobs last month, up from a mere 57,000 in June, with the unemployment rate holding at 4.2% and hourly earnings climbing 0.3% month over month, a key metric for inflation hawks. But a Reuters poll sees only 80,000 new jobs. And then there's Adam Schickeling, senior economist at Vanguard, who's way out on the limb forecasting just 18,000 new hires, warning of significant downward revisions to previous months' reports. One potential wrinkle, a World Cup hiring spree that never materialized, which may signal underlying weakness in leisure and hospitality. And new data from the New York Fed shows what they're calling a lousy job market for recent university graduates, a demographic canary in the coal mine. Watch the bond markets closely. Last week, after Warsh's news conference, bondholders drove up yields on long-dated treasuries, worried the Fed wasn't sufficiently tackling inflation. That sell-off speaks to a growing credibility gap, what my colleagues are calling a credibility shock, looming over the Federal. The market is questioning whether Warsh's vision of a quieter central bank that lets markets run their course is compatible with the inflation reality. Inside the Federal Reserve, the debate is loud. Governor Lisa Cook and Minneapolis Fed President Neel Kashkari both laid out cases this week for raising borrowing costs to tamp down inflation. St. Louis Fed President Alberto Musalem, a non-voting member this year, went further yesterday, saying the Fed was already late in raising rates. Bank of America analysts wrote to investors that a steady labor market and sticky inflation support our call for 3 hikes this year. And the Financial Times reports, citing unnamed sources, that Warsh may be more hawkish than many expect, potentially supporting a rate hike as soon as next month depending on the data and market reaction. The futures market this morning sees a 55% chance of a September hike. Bets on Kalshar are evenly split. President Trump, for his part, has repeatedly pressured the Fed to cut rates. A hike would most likely rankle him. We'll be following the Times' live coverage of today's report throughout the morning. Now, from macro policy to microeconomics, specifically, the plumbing of Silicon Valley. Here's an unusual conundrum. With startup valuations sky-high, venture capital funds are running out of capital to lead fundraising rounds. My colleague Sri Muppadai goes behind the scenes of the latest rescrubbing of the financing game. The scale and unrelenting pace of the artificial intelligence boom are driving markets and reshaping the global economy, but they've created an unexpected new challenge for VCs and startups alike. The problem? The average fundraising round is getting so big, even at the earliest stages, that it's becoming hard to find a firm willing and able to step forward as the lead investor and write the biggest check. Seed rounds are now billion-dollar rounds as well, says Gayatri Sarkar, founder and CEO of Advaita Capital, a growth-stage venture fund. The numbers bear her out. Through the end of June, there have been 7,541 fundraising deals completed for a total value of $412.7 billion, according to PitchBook. That compares to $319.2 billion in all of 2025 across 15,762 deals. Average deal size has soared. Step back, typically, multiple investment firms back a startup, with one lead investor setting the terms, valuation, governance, board seats, while others fill out the round with smaller checks. But with AI startups raising huge sums out of the gate, there are only so many firms that can dole out hundreds of millions to lead a round. Firms can co-lead, but that only stretches the pool so far. Case in point, Volta, an AI cloud startup founded just 7 months ago, raised $300 million this week in early-stage funding at a $2.4 billion valuation. The round was led by Silicon Valley heavyweights Azora, Andreessen Horowitz, Altimeter Capital, and Nvidia. Early-stage venture funds may only manage funds in the hundreds of millions, sometimes less than the size of a single AI startup's fundraising round. The result? Some VCs believe the number of firms able to lead major funding rounds will continue to shrink. We could see more leadless funding rounds. And if you're not the hottest startup in Silicon Valley, VCs say, it may take longer to rally investors and raise the capital you need. It's a structural bottleneck born of the AI gold rush, and it's reshaping the power dynamics of venture capital in real time. Speaking of power dynamics and legal reckonings, a New Mexico judge ordered Meta to pay $567 million yesterday, on top of a $375 million award from a jury in March that found the tech giant liable for designing products that enable harm to minors. The judge also required Meta to change how children access its platforms. The $567 million will go toward a fund to remedy damages caused by the company's practices. This is the largest financial penalty yet against Meta in its ongoing legal battles over social media harm and addiction, and it's just one front in a series of state lawsuits the company is battling. The jury found Meta misled users about the safety of its platforms and enabled the sexual exploitation of young people. For a company that's made its name on scale and engagement, this ruling strikes at the core of its product philosophy. While Meta writes checks, Alphabet is cashing them in, or rather, issuing them. Google's debt binge continues. Alphabet received roughly $115 billion worth of orders for its latest bond sale, more than 4 times what it was seeking, Bloomberg reports. Last month, investors punished the tech giant for its artificial intelligence spending plans. This time, they can't get enough. The appetite for Alphabet paper, even at a time of rising rates, tells you everything about the market's faith in Google's cash-generating engine, even as it plows tens of billions into AI infrastructure. Elsewhere in the chip ecosystem, SK Hynix, the South Korean memory giant, is set to spend $38 billion to expand production amid robust demand. The AI build-out is a global capital expenditure cycle unlike anything we've seen. But that capital flow hit a diplomatic snag last week. The Treasury Department made an unusual move to prop up Japan's currency, selling euros to buy yen. The Financial Times reports, citing unnamed sources, that the European Central Bank learned about the transaction only after the fact. Some ECB officials see the lack of coordination as a breach of long-standing conventions, potentially adding to European tensions with the Trump administration. Currency intervention is typically a coordinated dance among central banks. The fact that Washington went solo and sold euros to do it signals a willingness to bypass allies in pursuit of trade and currency objectives. It's a small move with large geopolitical implications. Now, from currency markets to the frontier of physical AI. If you spend time scrolling social media, you've most likely seen human-looking robots moving dexterously, backflips, warehouse sorting, delicate manipulation. Many of those robots, known as humanoids, are the product of Unitree Robotics, a Chinese company. On Monday, Unitree is set to debut on the Shanghai Stock Exchange, seeking to raise about $900 million in a public offering that would value the company at roughly $9 billion. This IPO will serve as an early litmus test of the market's interest in humanoid robotics, what Jensen Huang, CEO of Nvidia, has declared the next frontier for artificial intelligence, physical AI, or embodied AI. Here's why it matters. Today's AI systems, chatbots, image generators learn primarily from analyzing vast quantities of digital data culled from the internet. But humanoid robots will increasingly learn by interacting with people and objects in the physical world. Self-driving cars are one application, but humanoids are expected to operate in far more varied and unpredictable environments: factories, warehouses, stores, and eventually homes. For technology companies, humanoids represent an emerging market for chips and software. Morgan Stanley estimates the market could exceed $5 trillion by 2050, with as many as 1 billion models operating worldwide. The near-term commercial application is still small, but the long-term potential is staggering. The national security stakes are equally high. Last month, the Federal Communications Commission announced a U.S. ban on humanoid and quadruped robots from China. Security officials are concerned that robots deployed in commercial and residential settings could collect sensitive data. China denounced the move as discriminatory and threatened retaliation, its Commerce Ministry warning the ban would severely undermine the stability of China-US economic and trade relations, and seriously disrupt the stability of global industrial and supply chains. China is still powering ahead. Chinese manufacturers shipped roughly 18,500 humanoid robots in the first half of this year, compared with about 4,000 by US companies, according to Omdia. Unitree's products range from less than $5,000 to more than $150,000, spanning industrial, educational, and consumer markets. The robot arms race is no longer metaphorical. Let's speed through the rest of what's moving markets. Jane Street, the secretive trading firm, is reportedly in talks to refinance its $11 billion in debt with a small group of private credit investors. Apollo Global Management clinched a deal to buy EasyJet, the low-cost European airline, for £5.7 billion, about $7.7 billion, beating out the investment firm Castlelake. And in a stunning governance story, top FIFA executives were given just hours to approve a plan to sell a stake in the soccer governing body to outside investors. A multi-billion-dollar privatization project rammed through on the eve of the World Cup final. On the policy front, President Trump imposed a 15% tariff on products made with polysilicon, a critical component in semiconductors and solar panels, and set a minimum import price, aiming to support domestic production. The tariffs take effect in early December. Congress may hand Trump more authority to impose levies on some big trading partners, without the legal limits of current tariff tools. And a bipartisan ethics proposal that may be added to a big crypto bill could reportedly give Trump a huge tax benefit for his crypto holdings. In science, a genuine first, researchers used artificial intelligence to create entirely new viruses not found in nature. Scientists trained AI on libraries of DNA and asked the model to create recipes for viral genomes. 16 were viable, yielding new viruses. Published in Science, the study raises hopes for medical advances, antiviral drugs, vaccines, but also the disturbing possibility that the technology could someday be used to invent dangerous pathogens. Synthesizing viruses from scratch isn't new, but this goes well beyond duplicating known viral genes. The genie is out of the bottle. At Google, a shakeup of AI leadership has boosted the influence of Sergey Brin, a founder of the tech giant who's now focused on helping the company catch up to rivals. And a Bloomberg piece highlights a cultural phenomenon: young men who trade stocks daily feel like failures, a window into the psychology of a generation raised on zero-commission trading apps and meme stock volatility. A quick correction from yesterday: we misstated the amount invested in special-purpose vehicles on Sidecar's platform in 2022. It was $100 million, not $100 billion. Thanks for catching that. That's your DealBook briefing for Friday, August 7th. We'll be back Monday with the week ahead. If you have thoughts or suggestions, email us at dealbook@newyorktimes.com. Follow us on Instagram at @NetDealBook. Have a great weekend, see you Monday.